We knew it would be an impressive year for stock buybacks, but nobody was predicting over $1 trillion in share repurchases in 2018. Combined with QE, this has been the only reason why the stock market had risen. If it continues, the stock market will most likely surpass its previous high. The question is, can the FANG stocks carry the weight of the entire multi-trillion-dollar global stock market? You came here for the truth, so let me unveil that for you. Today we're going to look at what is going on with the share buybacks. I'm going to get into the real deal no matter how hard it hurts. I know that that's what you are here for, the truth and nothing but. So we're going to get into this today. I'm going to dig into it deep. I'm going to show you all the charts, the articles, and everything that's going along with this. Beginning with this chart, buyback authorizations have surged in 2018, and you can see Goldman Sachs estimates over $1 trillion in share repurchases throughout 2018. We are looking at numbers, obviously they're annualized. We're a little bit past the halfway point at this time, and yet they are still estimating that they are going to accelerate here in August, that's for sure, and we're going to get some numbers on this pretty soon to be able to determine how the stock market did during those time frames when we see the share repurchases going on, and so far always correlates with the stock market or those particular stocks rising, and it seems like there's fewer and fewer that are doing well these days. So that's Goldman Sachs, and this is TrimTabs. So they have actually gone up and calculated it all based on their estimations. They believe 1.3 trillion, and that is far surpassing 2017, which was an excellent year for stocks. And you can see what they have to do. Now, the trend is clearly here, where you can see that as the years go on, since the financial crisis, they've been buying more shares. They need to do this along with the quantitative easing because there's nothing else to push the market up. Retail investors make up such a small percentage of the money that's flowing into these stocks today. So that's the estimations, and we can see where we're already at. It's record breaking now. We're not even, nearly done the year yet. Looking at this here, August is typically the busiest month for buyback executions. Looking at this percentage of the annual corporate repurchase spend, 13% in this month alone. So if history is any guide, we can see that there will be massive amounts of shares repurchased throughout this time. This is provided to us by Goldman Sachs. Their reports, I don't agree with what they do as a company, but their reports generally tend to be pretty good. So we'll see how they do in this analysis. 13%, we're talking about big amounts. I mean, just look at what they've bought so far this year, and if we're going to see a 13% jump here, it's going to be something pretty significant. Now, this is some report that was done up, and it's trying to say that instead of using the share repurchases, you should be giving that money back to the actual people who work there. Okay, and I think it's up to the corporation to do whatever they want, but it really hits home when you read this info. It really makes you think. Okay, look at this. Okay, start from the top. The restaurant industry spent more on stock buybacks than it had made in profits, funding buybacks through debt and cash reserves. Buybacks totaled 136.5% of net profits. Companies in the retail and food manufacturing industries spent 79% and 58% respectively on their net profits on share buybacks. McDonald's could pay all of its 1.9 million workers almost $4,000 more a year if the company did this. Okay? If Starbucks reallocated from the share repurchases the compensation, that means every worker gets $7,000 in their raise. With the money currently spent on buybacks, Lowe's, CVS, and Home Depot could give each of their workers a raise of at least $18,000 a year. Think about what this would do to an individual's life. But instead, they enrich the company itself. That's all this is meant to do. They don't want to give their employees any more money than they need to. And I'm not even suggesting that we should force the company to do it somehow. And I just, I think that a corporation should be able to do what it wants as long as it's not breaking any rules or anything like this. What I see from this is that there's so much money there that's being utilized in a way that simply is benefiting a select few individuals. That's just what I wanted to highlight, okay? We're going to move on. This is constantly something I'm always focusing on. Number of members with a new 52-week high. So think of this as in the number of stocks breaking their 52-week high. Completely on a downtrend right here ever since basically June. Significant drop. And if you look at this chart further back, you can see what has happened here. I believe this is quoting the NASDAQ, but I'm not 100% sure, so don't quote me on that. But I've seen this so many times before. When you look at the stock market, understand where it really is at, okay? We need to be very truthful about it and very, let's just say take the emotion out of it. Defensive leadership continued last week. S&P 500 sector performance. This is just from July 30th to August 3rd, okay? I showed you last week how this looked very different. Very, very different, because you could see that tech is positive now. It was actually negative in that case, which we haven't seen much of that, but everything that happened with Facebook and Twitter and all these other stocks taking a little beating, that has really changed now. So look at this here with the S&P being positive 1.3%. We have energy down. The oil price clearly been hammered quite recently from its high that it experienced not that long ago, but it has been trending upward a little bit here. So we'll see. I'll show you that in a different video, in fact. Now, the top 20 stocks versus the bottom 400 is not the scale, as you can see from the percentages, but it's very, very telling to me when you look at Apple, Amazon, Google, Microsoft, Facebook, all right? So we got these, this is really one stock, but it's the different shares, but just think of this as the 5 companies, okay? Apple, Amazon, Google, Microsoft, Facebook. When you combine all of these percentages, this is nearly 20% of the market, held in 5 different companies. 5 different companies, 1/5 of the market. We have ourselves a complete concentration of the market, and that is never ever in history a good thing. That always tells us we are near the end of the bull market. It worries me not because my 7 shares of Amazon, it worries me because of your 7 shares of Amazon. That's right. But it also, in reality, worries me because of the people's pension funds that are not going to ever going to pay back what they owe individuals because they take so much risk. I'm not saying that they necessarily invested in the FANG stocks. They probably did. However, they're going to lose out as a result of the lack of understanding of economics. You cannot screw with history. It will come back to bite you in the behind. Cyclicals versus defensives, you can see that as moved up here in this case. And when I look at something like this, I'm always thinking of the earnings of a company no longer really matter. We have these general fundamentals or even the technical analysis that we look at and think to ourselves, well, these numbers are looking a little hot. We should probably diversify at this point. They don't do that. Investors never do that. When things are getting hot, they say, how much more can I put in? And that to me, it happens every bull market. I've studied many, many bull markets in depth throughout the years, been reading a lot of books, audiobooks, seminars, so many things. Spending literally thousands and thousands of hours of my life looking into this information, and looking at history, I know a lot of people, they are day traders. They just started maybe 6 weeks ago, and now they're a professional. So they know more than me. I'm not saying I know more than that person with their 7 shares of Amazon. I'm not, okay? That person knows everything. What I am saying is that we have to be engaging in trying, I'm trying to be nice here. When times get heated, we need to cool off, okay? And we do that by diversification. And I'm talking about real diversification, not a portfolio mixed of 35% bonds and 50% equities and 5% in cash and so on. No. That's not what I'm talking about. I'm talking about real diversification. I'm talking about different asset classes, and people need to, number one, wake up. But don't worry about it. We did see previously January practically, ruining the entire stock market. What was it? It was the VIX. They were shorting the VIX. Now today, we're back again to the same thing. They are doing the exact same thing today. Shorting the VIX at a very, very significant level. This type of behavior is going to occur again, and people are going to lose, and people are going to cry, and then we have to deal with the repercussions, and people start pointing fingers at the wrong individuals. It's the people in the casino that are the ones giving us, that are trying to be conservative, trying to be prudent, trying to be a little bit more wise, giving us grief. It's ridiculous. Now looking at this, Apple right here, by the way, at the top, S&P 500 companies with explicit 10% plus revenue exposure to Greater China. Apple Inc., if I followed this across, 20% exposure, their revenue is exposed to Greater China. We've got something to worry about. If you're worried about Apple stock, I realize it's $1 trillion company now, but that's a significant number. A lot of their revenue is tied in to China. If we've got problems in China, we got problems with Apple. Not just because of their massive manufacturing base, but also because of what's happening back and forth here. You could see all the trade issues happening, okay? I'm going to end it there. If you found this video informative, please give me a thumbs up. I like to cover the things that people just touch on. They just mention. Why don't we look into the data, and you can be the one to decide what you want to do with it. I'm not saying anything. You're going to see the hateful comments. You're going to see the spam in here, and that's fine. I'm not a fan of spam personally. I've never tried it myself, but some people find it delicious and they love to eat it up every day. Me, as far as I'm concerned, what I do is I take the data, I aggregate it. As you can see, I have like 50 tabs open right here. I bring all that information, I put together these packages for you. Hopefully it's easy to digest, unlike the spam. And that's it. If you do appreciate it, you can support this channel. All you gotta do, give me a thumbs up, leave me a comment below. If you don't know what to say hello, say hi, say hallelujah, say, summertime, say whatever you want, say Janet Yellen, shake it Janet Yellen, whatever you want to say. That's all right, enough with the silliness. If you found this video informative, I know you're going to find my books even more informative. This is the financial education you were not taught in schools, and that's the way I designed it. I made this purposely to fill in the gaps. That's a big gap of what the school should have been teaching us. So we're going to learn everything, okay? You read these 2 books, you got the whole foundation, okay? You'll understand what basically nobody knows, okay? The average person, nobody knows this information in here, and it goes all the way from the foundation to the asset classes, how to profit from it, how to actually invest what you've learned. All right, so check them out. Link is in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.